Good afternoon, everyone. Today, we are diving deep into one of the most significant milestones in people's lives: homeownership. For many of us, owning a home isn't just about having a roof over our heads. It's about making an investment, securing financial stability, and achieving something that symbolizes independence and success. But the road to homeownership can be complicated. You might have heard the term mortgage thrown around, but how many of us really understand what goes into the home buying process? How do you know what type of mortgage is right for you? What is the best way to manage the costs associated with buying a home? These are just a few of the questions I will help answer today. Now, before we dive into the details, I want to encourage you to hit the subscribe button if you find this valuable, and stay tuned for more tips on navigating finances and the world of real estate. With that said, let's begin our journey into the world of homeownership and mortgages. The importance of homeownership. Owning a home is often considered a cornerstone of the American dream. There's something uniquely fulfilling about having a place that is entirely your own, a space where you can truly make decisions based on your needs, style, and preferences. But homeownership is more than just a physical space. It's a financial opportunity. Every month, as you make your mortgage payments, you are building equity. Equity is the difference between what your home is worth and what you owe on it. Over time, as property values increase and your mortgage balance decreases, you're building an asset that could become one of the most significant sources of wealth in your life. In addition to equity, homeownership comes with tax advantages. For example, homeowners can often deduct mortgage interest and property taxes from their annual tax returns. This can lead to significant savings, especially in the early years of the mortgage, when the bulk of your payments go toward interest rather than the principal. However, homeownership also brings significant responsibilities. Maintenance costs, property taxes, insurance, and unexpected repairs all require careful planning. Yet with proper financial management, the benefits far outweigh the challenges. Understanding mortgages. A mortgage is simply a loan that allows you to purchase a home without paying the entire amount up front. It is a long-term loan, typically paid off over 15 to 30 years, that you repay in monthly installments. The basic structure of a mortgage involves two main components. Principal. This is the actual amount you borrow to buy the home. Interest. The cost of borrowing the principal amount, which is expressed as a percentage. The lender provides the funds to buy the home, and in return, they hold the home as collateral. If you fail to make payments, they can take ownership of the property through a legal process known as foreclosure. There are different types of mortgages, which offer different repayment structures, interest rates, and terms. Understanding these options is key to making the right decision for your financial situation. Let's take a closer look at the most common types. Types of mortgages. There are several mortgage types available, each offering different benefits, terms, and suitability for different situations. Let's go through the most common types of mortgages. Fixed-rate mortgages. A fixed-rate mortgage is the most traditional type of mortgage. The key benefit of this type is that your interest rate remains the same throughout the term of the loan, typically 15, 20, or 30 years. This stability is a huge advantage for homeowners who want predictability in their monthly payments. With a fixed-rate mortgage, your payment structure is straightforward. You pay the same amount each month, and over time, you pay down the principal balance and interest. Pros: predictability. Your monthly payments remain the same for the life of the loan. Financial planning. It's easier to plan for future expenses since your payments won't fluctuate. Long-term stability. Ideal for homeowners who plan to stay in their homes for an extended period. Cons: higher initial rates. Fixed-rate mortgages tend to have higher interest rates compared to adjustable-rate mortgages, especially in the initial years. Adjustable-rate mortgages, ARMs. An adjustable-rate mortgage offers a lower initial interest rate, but the rate can change over time based on market conditions. Typically, ARMs have an initial fixed-rate period of 3, 5, 7, or 10 years, after which the rate adjusts periodically. Pros: uncertainty. Your payments could increase significantly after the initial period, depending on interest rate changes. Risk: if interest rates rise, your monthly payments could become unaffordable. FHA loans. The Federal Housing Administration, FHA, insures loans made by approved lenders to borrowers with lower credit scores or limited down payment savings. FHA loans require a lower down payment, often as little as 3.5%, making them an attractive option for first-time homebuyers. Pros: low down payment requirements, easier to qualify for with lower credit scores. Cons: requires mortgage insurance, which increases the overall cost of the loan. Limits on loan amounts, depending on the region. VA loans available to veterans, active duty service members, and certain members of the National Guard and Reserves. VA loans offer some of the best mortgage terms available. They require no down payment, no private mortgage insurance, PMI, and offer competitive interest rates. Pros: no down payment required, no PMI requirement. Cons: only available to eligible veterans and service members. May require a funding fee. USDA loans. The U.S. Department of Agriculture, USDA, offers loans to buyers in rural or suburban areas. These loans are aimed at encouraging development in these regions and offer benefits such as no down payment and low interest rates. Pros: no down payment required, lower interest rates than conventional loans. Cons: geographic restrictions, only available in designated rural areas. Income restrictions: your household income must fall within USDA limits. The mortgage application process. Understanding the mortgage application process is crucial to securing a loan. This process involves multiple steps, including pre-approval, choosing a lender, submitting your application, and undergoing underwriting. Pre-approval. The first step in the mortgage application process is pre-approval. Getting pre-approved means that a lender has reviewed your financial information and determined how much they are willing to lend you. Pre-approval is not a guarantee of a loan, but helps you understand your budget and shows sellers that you are a serious buyer. Choosing a lender. Once you are pre-approved, it's time to shop around and choose a lender. It's important to compare interest rates, loan terms, fees, and customer service reviews. You want a lender who offers the best deal for your situation, not just the lowest rate. Submitting your application. To complete your mortgage application, you'll need to provide detailed financial information, including income verification, pay stubs, tax returns, etc., credit history, your credit score and credit report, assets, bank statements, savings, etc. Underwriting. During underwriting, the lender evaluates your application, verifies all your information, and assesses the risk of lending to you. The underwriter may ask for additional documentation or clarification before making a decision. The costs of buying a home. Buying a home involves more than just the down payment. You must also consider closing costs, property taxes, homeowners insurance, and maintenance costs. Here's an overview. Down payment. A down payment is typically 20% of the home's purchase price, though many loans allow for smaller down payments. The size of your down payment will affect your loan amount, monthly payments, and the type of mortgage you qualify for. Closing costs. Closing costs include various fees, such as title search and insurance, appraisal fees, attorney fees if applicable, loan origination fees, home inspection fees. These costs usually total 2 to 5% of the home's purchase price. Property taxes and homeowners insurance. In addition to your mortgage payment, you'll be responsible for paying property taxes and homeowners insurance. These costs can vary greatly depending on the home's location and value. Maintenance costs. As a homeowner, you are responsible for maintaining the property. This includes regular upkeep, repairs, and upgrades, which can add up over time. In conclusion, homeownership is a huge step in securing your financial future, but it requires careful planning, research, and understanding of the mortgage process. Whether you're a first-time buyer or looking to refinance, it's essential to know your options, understand your financial situation, and make informed decisions. Remember, homeownership is not just a financial investment, it's an emotional investment too. The home you purchase today can become a cornerstone for your future, both financially and personally. I hope this information helps you on your path to homeownership. If you have any questions, feel free to reach out, and don't forget to subscribe for more helpful content like this.